Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I'm Arjun Parsati. And in this podcast, we are going to talk a lot about all the happenings in the bond market and across what's happening, all the kinds of issues that are across the globe that is impacting bond markets globally and in India as well. And going into the next financial year, which is the April 26 to March 27, the financial year. What should investors be looking at in terms of managing the bond portfolios, and what will be the theme that is going into the next financial year? So clearly, there is a lot of issues that are impacting markets, right? As I mentioned earlier, and let me highlight the issues. But before we start, investors should understand that bonds do carry credit risk, where risk of default, liquidity risk by buying and selling could come at a big cost, and the interest rate risk where prices can move up and down. Investors should be aware of their risk before investing in bonds. And also that those of you who are listening, who are followers of Let's Talk Bonds, or those who have been listening, please do subscribe to all our podcasts, to all our podcast channels for regular updates on the Let's Talk Bonds podcast. And yeah, let's get back to the topic that we have been talking about for this podcast. Um, yeah, so many issues. I mean, if I'm just looking at everything on the top of the mind, the first could be the current situation in the Middle East, the war that is going on, and that is where is the impact of that war? Clearly, one is the oil prices, that is, commodity prices are moving up. The second is that the supply of goods have been constricted. That's also impacting prices globally. Then the uncertainty on across in terms of travel, in terms of every other aspect of every other aspect, all that is put together has clearly created a lot of volatility in markets. We have seen just after the once the war has started, India has seen the rupee depreciate against the US dollar. It's trading at record lows of over rupees 92 to the dollar. The USD INR has really gone up in terms of has strengthened with the rupee depreciating and the dollar appreciating against the currency. Also, that outlook for inflation now with all these commodity prices and increase in prices for goods which we import, that's also could be having an effect on the policy. So that's also impacting bond yields. So government bond yields have gone up and stayed at higher levels. You also have then the prospect of next borrowing coming up next calendar, where the central plus state government borrowing is crossing over rupees 30 lakh crores or rupees 30 trillion crores and 30 trillion. And this is going to be really, this is worrying the markets on terms of how can the supply be absorbed. RBI has been buying a huge amount of bonds in the market through both through the secondary market and through OMO, open market operations, purchase of bonds, auctions. But despite that, market is still worried how can this be absorbed. So all this put together is impacting the government bonds in India and the government bond yields in India, and with inflation prospects rising, the higher duration government bonds, the long maturity government bond yields are also rising. So clearly there is some uncertainty in this. Then you look at on the global front, you look at the stress that is happening in the private credit markets globally. So that is while it's not filtered down to anywhere, it's a global phenomenon, very largely in the US, right? Where there have been huge flows into the private credit markets there. But purely in that sense, the whole talk about a private credit market coming under huge stress, and on a daily basis, you get to hear what's happening in the private credit markets, funds stopping redemptions, etc. So many other things. So that sends out that's in an optic sense. That is, even though there is no direct impact anywhere across the globe, at least in the domestic credit markets across other countries as well, But in an optic sense, that with everything else put together, there is a fear. And then you have the disruptions in the AI, which is creating volatility in equity markets, and how it will affect businesses. Um, then you can also have the fact that the what could be the could be the impact of higher prices on U.S. inflation. It's the U.S. inflation has been rising, and U.S. Treasury yields have also been rising. So all put together, there doesn't seem to be any kind of a respite for markets, whether it's equities, whether it's bonds, at least on the high grade bonds or government bonds. There doesn't seem to be any respite for the investors there. So, what do investors in India do for bonds? Clearly, if you look at the performance of bonds last year, the performing bonds have been the high yield bonds, which is the bonds in the bonds rated AA and below. The government bond yields have moved up, AAA bond yields have moved up, and PSU bond yields have moved up, and uh, the highest high grade bond yields have moved up, whereas the high yield, this is the lower rated bonds, yields have actually moved down or have stayed stable. So clearly, markets have been discerning here in terms of, one is they have been choosing to go for bonds that are fundamentally the visibility of credit worthiness is good, and where they're offering yields are higher. So if you look at the range of AA to triple B plus bonds in India, the yields are in a range of around 9.5 to 9% to around 14.5%, depending on the bond. Mostly in a range of about 10 to 12%. That's the sweet spot. And here the yields have been pretty much stable, and actually most we are seeing many of the yields actually coming off. So many of the lower rated investor issuers bond yields have come off at least by about 100 to 150 basis, 100 to 120 basis points in the last 1 year. In the last 1 year, and many of them have got rating upgrades. I'm not going to talk about specific issuers here, but I'm just giving a general trend. You can always come to INR bonds and find out what are the bonds that have really performed. We have a retail high yield bond index, which tracks seven issuers with a 3 year constant maturity index. This index, the spreads have come up from the spreads between this index and the 3 year government bond have come down from 420 basis points in the last to 360 basis points over the last 6 months, clearly showing that while government bond yields have risen, the high yield yields have actually come down, or some of them have stayed stable, and this is leading to contraction in spreads, which is also a perception of the credit risk in the market. So then the other factor to watch is, given that there's so much of borrowing going to happen and RBI is going to support the borrowing, there's going to be a lot of liquidity in the market. But with all this economic uncertainty is there, what will be, even if the war starts, what will be the aftermath of that? Will be risk taking? What could be the outcome of the private credit stress in the US? Can it impact the high yield markets there and then filter down across the globe? So a lot of things to watch out for. In India, what do investors need to do? They have to I think look at each bond individually. Clearly, one is, can you look at duration? Doesn't look like duration is a great idea. So because if you just taken rising inflation expectations and high borrowing, both are not going to be helping long dated government bonds or PSU bonds. So you need to investors do need to look at where can the best risk return profile be. That they need to come down to the short dated bonds, which is a 2 to 3 years. And if you look at the high grade bonds on that, they largely track the repo rate. The repo rate is at around 5.25%, and this will really this is and if the liquidity is going to be easy, the rates are going to be very soft there. So there's not going to be much of pick up in yields. So clearly, I think your investors do need to really look at the um, high yield bond space. But here again, not everything, not every bond is going to perform. There will be, they'll have to look at the segments. For example, would uh, if they're looking at NBFC bonds now, which would the best bonds be in the unsecured lending space, or it could be in the secured lending space of MSME and SME, or through LAPs and others? Could it be in some other segments, microfinance, which is again unsecured, but then they've come out of a rut over the last 1 year? Could it be some other space, that is education space? So each has to be looked at individually. And could there be special situations? For example, could there be large? Definitely, we have seen a lot of interest from global players taking large stakes in Indian issuers, Indian lenders. Clearly, they see the India as one of the largest, fastest growing market for the lenders in this, especially the non-bank lenders, and hence a huge amount of money that is coming into these lenders. Some of the deals that have happened are a Fullerton taking over lending card. You have Bain taking a stake in Ashirwad. You have some of the PE guys, Warburg taking control over Fusion Microfinance. You have IHC, which is the Abu Dhabi Wealth Fund, taking a large showing taking approval to take promoter stake in Saman Capital. You have some of the Japanese banks coming and taking over stakes in the Indian lenders like Shriram Finance. So all this is clearly highly positive. Global capital is definitely coming into India, and so if investors are looking at these kinds of situations where they look the once a large, good, high-profile global lender, global institution, which can the moment they take a controlling stake, then the quality of the credit rises substantially. Most of the times, you'll find that the credit rating is going up from triple B plus to minimum of double A minus, and then going up from there depending on how the institution is positioning itself. Mostly, it will go to say a double A or double A plus or even triple A. We have seen cap safe going to AAA with the Japanese bank stake. All this put together, I think it's a pick and choose market for bonds. Investors need to look at each bond in its own merit, the risk return it provides. Would you want to look at only gold as a gold as a 100% gold loan lenders, because they have a very liquid asset when they're lending, or only mortgage lenders? All these need to be taken into consideration, and the best place, and obviously each decision has to be on its own merit. But if investors sit and pick and choose on bonds, the returns can be very high, very good, very stable, and sometimes even outsized, especially if there is a good M&A possibility or other special situation possibilities, or infusion of capital by private equity, or infusion of capital by the promoter, etc. All put together, I think this is how investors should look at bond investments in the next financial year, which is the 26-27 financial year. Thank you for listening in, and do follow us on all podcast channels.